Good morning to everyone. I think we'll start talking on a certain aspect on what the Institute recently had set out, mandatory from 1st April 2023 to be compliant with certain audit firms. This is on the audit quality maturity model. Now, why has the need for an AQM or a model on audit quality necessary? Let's look at it from three perspectives. What is the current status of how we are doing audits? What the regulators and market expectations are, and then let's go through the three subdivisions that are covered under the AQM. Firstly, the current status of audits. Where are we as far as audits are concerned? Now, it was in 2001 that we were taken by surprise with regard to what happened on Enron. It was a scandal. Yes, the auditors were pulled up for it. Result was a firm which was perhaps the largest that was there at that point of time. Going further, what happened at the Enron scandal? It was, yes, pertaining to related party transactions. It involved, group auditors not being fully involved, perhaps relying on the work done by other auditors rather than fully having done something on their own. A lot of things came in. Result, one of the largest firms practically disappeared from the face of the earth. They ceased to exist. It was taken away by a lot of other firms. Shareholders lost a lot of money. Result of this, of course, was a new regulation called Sarbanes-Oxley that came in, which is also now incorporated in India as internal financial controls on financial reporting. Next aspect that came was with regard to Lehman Brothers in 2008. Again, it was a financial crisis. A lot of housing loans became houses on the balance sheets. These are all disguised as sales. There were a lot of accounting loopholes. This impacted the reputation of the auditor that was involved. It was considered as poor auditing. This also resulted in a lot of changes. There were new IFRS standards that came in. There was a change in the auditing reporting requirements with the new ISA 700 coming in. There was also ISA 701 that came in with regard to key audit matters from 2015 onwards. So these were all the regulatory changes that took place because of this scandal. And of course, we have our own Indian origin Satyam scandal. This also was resulting in inflation of sales and a lot of other accounting irregularities that came in. Impact, again, of course, the reputation of the auditor was significantly impacted. They received a 2-year ban as per SEBI requirements. Now, this also resulted in a lot of revision in the regulations in India, more so with the Companies Act 2013 being the result of it, as well as mandate of IFC reporting. There was additional regulations on auditor rotation that came in. A lot of other changes came into India. Now, what was common in all the three? In all three, of course, it was fraudulent, but the resultant was that the auditors did not, during the course of their audit, identify any irregularities, which, of course, the regulators felt were apparent, visible, and should have been identified by the auditors. All of this resulted in a lot of regulatory changes. There were revisions in existing standards. This was both as far as IFRS and consequently in India, as far as Ind AS is concerned. The auditing standards, there was a huge shift and the auditing standards got revised internationally and in India in 2010. So all of these changes took place. There was significant increase in the governing responsibilities for directors. The new Companies Act, of course, put responsibilities on independent directors, but the SEBI regulations also did the same. There was an increased scrutiny over related party transactions. I'm sure all of you would be aware with the SEBI requirements on what are quarterly declarations that companies need to give on transactions with related parties. Of course, this scrutiny has been different from different regulations, and therefore we do find some differences in definition as to what the accounting standard looks at, what the Companies Act looks at, and what the SEBI's requirement of filing is. Now, these are also resulting in additional disclosures, additional requirements, the BRSR reporting, various other changes in what is required to be included in the board report, the MD&A. New laws, of course, as we discussed, the Companies Act 2013 came in, formation of the NFRA came in, there were new peer review mandates, inclusion of this currently what we are discussing, the AQMM requirements, as well as increased scrutiny by SEBI. SEBI has been coming out with various notifications. All of these are covering, auditor rotations, increase in auditors' responsibility, and the need for oversight from the NFRA. There were additional reporting requirements that came in. Of course, 143.12 has its own uniqueness of auditor having to report on fraud. The NOCLA requirements of commenting on any non-compliances that any member of the institutes identify. The reporting in CARO under Rule 11E and F that came in, as well as the NFRS requirement that was recently circulated on the auditor transparency report, which going forward should become mandated to auditors of listed entities. So all of these are coming up from the history of instances where it was felt that audit quality had failed. As to focus on auditors, yes, you have the peer review that the institute set up. That is to ensure that the audit firms that are carrying out audit of any entity, whether it's listed or unlisted, are complying with technical, professional, and ethical standards. That they have placed in their process proper systems, including documentation of audit quality. The FRRB review. This is also on quality on reporting. They look at the financial reports that have come out to see whether all necessary disclosures have been complied with. Now, in addition to informing the company, they also lead out to the auditors to provide them guidance and what could be best practices. Then you have the QRB review. This review covers the quality of services being provided by the members of the institute, including specifically for audit of both private as well as unlisted entities and listed entities. In addition to this, newly, we've also got the NFRA, who's now got the power to monitor and enforce compliance. And if necessary, take, additional debarring of the firm or debarring of the relevant member involved from conducting audits for extended periods of time over and above what the Icai might have done. So these are all new aspects that are coming, new focuses on auditors slowly increasing one by one, and all of them in a way focused directly or indirectly on quality of audit. In addition, what is that has changed? There is something that was known as an audit expectation gap. Our past president, Mr. Debashish Mitra, did mention, and he was quoted in the newspapers as well, that audit is a serious business and one should stay away from it if they're unable to meet this expectation gap. Now, what do you mean by expectation gap? Now, there have been a lot of studies that have been carried out. Is as way back as 1978, there was an evaluation done what was the gap between auditors and those who rely on the audit reports. This gap between what public perceives the auditors ought to do and what the auditors can reasonably do was considered as the expectation gap. Further analysis was done in 93 again, and this gap was further resolved into two: difference between reasonableness and performance components of what the auditors are actually doing. Now, all of this, when they get identified, yes, we do agree that there is a gap of what the public perceives auditors are carrying out. Now, and there are certain aspects of what the auditors feel our responsibilities are restricted. There is that famous quote that we are not bloodhounds. But again, whether we are watchdogs or bloodhounds, I think it is important that we maintain certain levels of focus when we carry out an audit. It may not be necessary we carry out a forensic, a deep investigation engagement for a fraud, but at the same time, I don't think we can do an audit with our eyes closed. These are differences in expectations that have come up. And these expectation gaps are getting, smaller and smaller over a period due to certain aspects such as regulatory changes, new standards coming in, more focus on the requirements of disclosure. I'm sure all of you would have seen that when India's financial statements got prepared, the size of the financial statements more than doubled from what it was earlier because the amount of disclosures that came in was significant. Intention was that this reduces the expectation gap with a lot of more information being shared, all this information being required to be audited. Now, again, there's a certain perception on performance. Have the auditors carried out everything that the public expects them to do? Now, yes, there are some shortcomings. There are some what is known as deficient standards. And over the years, auditing standards have been undergoing a lot of changes. Yes, we do have a slight, difference as far as India goes from ISA 600 and SA 600. The scope and responsibilities are a little different. And therefore, India is still in the process of having to incorporate the requirements of ISA 600. The other aspect of performance gap comes in is from deficient performance. This is where the auditors have not done what they're supposed to do, at least under the standards. One is the standards not really covering all the duties. The other one is, though the standard exists, auditors not complying with all the requirements. So when we look at expectation gaps, what are these aspects and what can we put in? Logically, we can work out about one, are the auditors playing the necessary role on fraud detection? Are we hiding behind the term that we are watchdogs and not bloodhounds and therefore not doing sufficient work around fraud? The responsibilities to third parties. Yes, our audit reports are addressed to the shareholders or members. We report on our findings to the board or those charged with governance. But our reporting is not restricted to them. There is a responsibility that we have even to the regulators, to the government, that we are providing sufficient reporting requirements that may be there. The same accounts go in for tax audit purposes. Therefore, have we addressed that they are also the users? It's not just shareholders. The tax officers are also users of these financial statements. So these responsibilities also have to be understood. Now, there's a lot of talk. Should audit firms be isolated to carry out only audit and not have any other capabilities? Now, in this day and age, with NDAs coming in, a lot of items on the balance sheet are carried at what is known as fair values. Now, the question does arise, do auditors have the necessary capability and experience to actually evaluate the different forms of valuations that come into a balance sheet? Or do we have to extend and involve specialists that come in who have the specialty to carry out these valuations? In a lot of cases, the firms do not have. This also could extend to IT auditors. With all the technology revisions that are happening, does the audit firm or auditor have their own internal capability to do this, or do they have somebody else on rolls or contracted to actually carry out the necessary work that requires to be done? A lot of conversations, and you might have seen in a lot of the NFRS reports also, there's a significant amount of discussion that comes around auditors' independence. There are talks that people say, is the auditor independent if it's the management who decides on the fees that is being paid to the auditor, or rather the company is paying it? Though yes, professionally speaking, regulatorily speaking, the appointment is not done by management, by the shareholders instead. But the way things go, the discussions are done with management, the evaluation is done by the audit committee or the board. The shareholders probably just acknowledge it. Again, on the fee, though principally the shareholders are required to approve the fee, but the standard approval is rights are given to the board. The board takes consideration of what the management has to say, and that's how they decide on the fees. Now, will that impact auditors' independence? It may not impact independence, but it could impact quality if the fees are negotiated lower than what an auditor actually deserves. So there is a lot of focus on what the auditor is getting paid. Aspects of actually conducting an audit. Does the auditor have the necessary experience to be actually able to identify what risks are impacting the business? What risks are impacting the industry? What are the risks as far as financial statements go that require focus on? One of the questions that comes in is, and we'll try and cover it also if we can, on key audit matters that came up as a requirement of reporting. Are the auditors actually able to identify which matters are key audit matters? Because that has to be arising from those identified as significant or high risk on an engagement. So if risks are not adequately identified, the CAM may not get identified. There is an element of uncertainty that in an audit also that comes in. We carry out sample checks. We do not do 100% testing. We are required to give a true and fair opinion. We do not give a true and correct opinion, because as auditors, we do factor that there could be certain elements of uncertainty involved in these financial statements, a level of misstatement that could exist. The only comfort we give is, even if there are misstatements in these financial statements, none of them are considered to be material. So the approach is only on that. Now, are we able to evaluate what is our appropriate materiality? Are we able to ensure that the financial statements we do provide, the level of misstatements, if any, are sufficiently low that does not impact the readers in any way? Now, these are elements of professional judgment, and therefore a lot of expectation gap comes in, because when there is an element of judgment, not necessary that every two persons come to the same conclusion, and therefore a lot more need of documentation and improvement on quality comes in. There was also an ACCA report that came in where they looked at what this performance gap is on, and they split it into three. One is the knowledge gap. That is the gap between what the shareholders or stakeholders or public thinks the auditors are doing and what the auditors actually do. That's a knowledge gap. Performance gap is between what the auditors are actually doing with what they're supposed to do. As we discussed earlier, standards require the auditors to do it in a certain fashion, but what they actually do is what they feel is right, need not necessarily be fully compliant with what is there in the standards. So that is a performance gap in itself. And then there's an evolution gap. When you say evolution gap, there are changes in technologies that are happening, increased expectation, lot of variability in industries, implications coming in from across the globe. So does the auditor have the necessary skill sets that come in to actually understand what is happening? This is the evolution gap. The key focuses that are coming in to bridge these gaps into all these three aspects is one, as far as knowledge goes, a lot more information is coming out to the public to understand what the auditors are actually doing. This resulted in two changes. One, the SA 700 that came in became a far more detailed audit report. Additionally, 701 came in to give key audit matters, wherein the auditor actually explains to the shareholders what were the areas of focus for them and what did they actually do as procedures, hoping that the shareholders, when they read the report, have a better understanding on what has been done. But that is far as what is being done. What should the auditors actually be doing? How do we ensure the auditors are actually compliant with all the requirements of the standard? This has come up with various inspections. I think I showed it in the earlier slide, where you have aspects of peer reviews, you have your QRBs, you have your FRRBs, you have your NFRA review. All these inspections that are getting done is with the intention to ensure that this performance gap can get reduced. Also, there are a lot of revisions that are happening on the auditing standards, at least internationally. In India, we are still supposed to, I think, slowly follow and get those revisions into India as well. And that should be happening over a period. We also expect perhaps the NFRA may come up with additional guidances, similar to how the PCOB did in the US, as to how or what auditors should do as far as audit of listed companies are coming. And from an evaluation gap, yes, there's a lot of discussions going on how to get the shareholders, the audit committees, regulators, everybody together on what is required to be done. A lot of new technical papers, white papers out for public comments and evaluations. And hopefully this evolution gap, as things change, will get bridged with all the new changes that have to come in. So what does all this mean on audit quality? Yes, Aqmm, at least the version 1 that has come up, is considered from two aspects. The institute is hoping that A, it helps build capacity, and 2, allows you to evaluate the quality of work that is being done by that firm. Key points to keep in mind. This is a self-review mechanism, but yes, this is also subject to an audit by a peer reviewer or the Aqmm reviewer. There are 4 levels of scoring. It moves from L1 to L4, and we'll discuss that in a couple of slides. The level of the firm, when they do the self-evaluation by looking at all the various criteria, which significantly require yes and no to be done by the firms when they do the self-evaluation. And of course, evidences to be provided when they get audited by a peer reviewer or the Aqmm reviewer. These self-evaluations are more so for the firm to evaluate where they stand and what is it they need to do to the next level. They cannot publicize what their self-review ratings are. However, once a peer reviewer comes in, carries out an audit of this evaluation, confirms where the firm stands, was it L1 or L2, 3, or 4. That, however, will become publicized and will be available for viewing by all stakeholders on the ICAI website. Now, what are these levels? Level 1 is for the firms which is getting the lowest score, which is less than 25% or 25 points coming in across. This is where to say the firm is still very new, lacks experience, is still upgrading its capabilities and capabilities. Level 2 is where I think they've got about 25% to 50% of the scores across all the categories that are there. This indicates a firm is making progress. They are in the process of growth, improving where they stand. Level 3 is where they had 50% to 75% of the score. And this is where a firm has made substantial progress and is about in the process of moving up higher level of competencies. Level 4 is where at least the firms have more than 75% scoring across all parameters. and it shows that the firm has substantially adopted all the requirements of audit quality, but however, is still focusing on optimizing itself further. Now, understanding these 4 levels, one of the risks that I do perceive will come in once this starts becoming more publicized, post the peer reviewer or Aqmm reviewer actually going through this. All the stakeholders, that is the audit committee and those charged with governance, in all probability would look at appointing auditors who at minimum are level 3, if not all at level 4, to actually ensure that quality of audit is being maintained. So it is very critical that the firms start looking at where they are and put up a clear-cut plan of where they should be to be able to move to level 4, at least from where they are now, or once the next round of rotations come in, to make sure they are there to increase the chance of getting selected. Now, who is this applicable to? For the time being, where it becomes mandatory from 1st April onwards, it's applicable to the firms which audit listed entities, audit banks, and insurance companies. However, there's a small exemption that is given currently, saying if the firm is only doing a branch audit of a bank or insurance company, then currently they are not covered. But if they do branch as well as the head office, then they will get covered. I think we've discussed on L1, L2, L3, and L4. But what are these sections that we are talking about? So the Aqmm is split into 3 sections. First one is practice management as far as operations go, which has the maximum score of 280 points. Then there's human resource management, which has about 240 points. The overall practice management, which is strategic and functional, which has a lower score of 80 points. In total, this comes to about 600 points, which means you have to, at minimum, in order to be able to get L1, we should be at 70 or lesser. For L2, you should be scoring, in case of practice management, between 71 to 140, 61 to 120, or 21 to 40. Only if you score between these numbers in all the 3 categories, you will be L2. Again, the range that is there for L3, range in L4. The requirement is you meet somewhere between these from and twos in each of the categories. If you fall down below, you might fall down below entirely. For example, if you are between 141 and 210 as far as practice management goes, but you are 61 to 120 as far as human resource goes, and 0 to 20 as far as practice management goes, then you would not fall under L3. Chances are you'll fall either under L1 or L2. And therefore, it is required that you meet this minimum to maximum range that is applicable here for each of the levels to be able in all the sections of practice management, human resource, and strategy and function. So practice management, what does this actually cover? This is further broken up into 9 categories, out of which you will observe a lot of focus is on quality reviews and quality control. A significant portion goes on that, as well as focus on technology adoption. So how do we look at this? Practice areas of the firm. It requires that the significant portion of revenues coming into the firm should be from audit. And it should be for a continuous period of 3 years. The reason I've got an asterisk there is a small exemption provided. The 3-year category does not come in if a growth is coming up from mergers of firms that took place, a coordination of networking of firms that has taken place, resulting in increase in revenues. Then the continuous period of 3 years may not apply. Otherwise, the audit revenues significantly should constitute at least 50%, if not 75%, to actually be able to get any points on this category. There is a clear-cut vision and mission statement that is coming up, addressing forward-looking practices and plans that the firm has. How do they intend to improve their quality? What is it they intend to do? Some factors. In order to be able to ensure that your audit revenues of past 3 years meet a minimum requirement of 50 to 75. Does that mean the audit practice has to be a separate firm? Because if it is coordinated with tax services, other valuation services, and accounting services that a firm is capable of providing, then would it result where the audit revenues is small? Principally, I don't think that is the intention. Whether you split into multiple firms, if you're still associated, related, forming part of a network, I think it would still be considered consolidated basis. But that is something that we will need to see as time proceeds and the application actually happens. documentation is required. One of the key aspects of all these sub points that we are going to be discussed, in addition to having what is required to be done, it is also required to be subject to audit either by peer reviewer or Aqmm reviewer, which means as what we expect when we do an audit of financial statements, there should be sufficient evidence that is supporting whatever statements or claims that we as auditors will make. Which means if we are claiming to have a vision and mission statement, there should be clear-cut evidence of what this is and where is it documented, because having a vision and mission just for yourself is not sufficient. That vision and mission should be available to all partners of the firm, all chartered accountants in the firm, all article assistants in the firm, that is all staff. It should be cultivated down to all of them, and it should be ensured that all of them have clearly understood what the vision or mission of the firm is. Therefore, implementation evidences should be maintained. Key of both the vision and mission statement, if you look at the guidance the institute has provided, it is rooted on ethics and quality. And therefore, both the vision and mission should somehow cover both aspects of ethics and audit quality. The next factor that one looks at is on workflow and practice manuals. And as we discuss, I will also highlight to you that each of these subsections are interrelated. For example, when we're talking about practice manuals, we'll also move into the next 1.3, and you will see there is an impact between 1.2 and 1.3. You'll also see an impact between 1.3 and 1.4. You'll see that going on into 1.7 and 1.8, and you'll find these are all interrelated, which means when you say yes in one, it's difficult to say no in the other. So similarly, if there's a no in the other, you cannot be saying yes here, and therefore both could end up as no. So one should very carefully evaluate the responses they're doing as part of the self-review. So there's a clear identification of areas of improvement. So what does one require in practice manuals? The need for an audit manual, which means just the fact that the firm is exercising or implementing the auditing standards is not sufficient. There should be a documented manual giving highlights. It's like an SOP, providing sufficient direction to all staff on what do they need to do to ensure compliance with the necessary auditing standards. So there should be a need for a manual. Standard formats. In addition to having a manual explaining how an audit is to be done, there should be templates that are available to all staff covering what should be the standard format of an engagement letter, what should be the standard format of a representation letter, how do we document and therefore format of work papers that will be maintained, a standard format of an audit report that all people within the firm will take for reference before they modify it as necessary. In addition to having these templates, there should also be a mechanism where A, the firm has ensured that everybody is aware of the standard templates, and B, that all of them are actually using the standard templates. Key, if you are not using a standard template and considering a change or revision, how does this get communicated between the relevant leadership in that firm and these changes are approved before they're actually implemented? Our overall process around this is also key. So we have to ensure that we have a manual covering planning and risk assessment. And I think in one of the other slides, we'll be coming in on different risks that one needs to evaluate as far as acceptance of a client itself is concerned. Ensuring there are standard audit procedures, that is minimum work that everybody in the firm will get done on each account balance. And additional work is done solely arising out of the risks that get identified. So standard audit procedures, formats of work papers, so that the staff is more focused on the audit and quality of audit rather than working out on how do I document this, in which format should I document this. That confusion should not come in. Overall, how is all this being implemented? What is the process the firm has set in place to ensure that this application is done as intended, which means there should be a monitoring process. Audit quality review manuals or tools. Now here, this looks at, again, all of these are yes/no answers. And as you answer these questions, you get your points. And each of these 6 questions have 8 points each if it's yes, and 0 if it is no. So there is no mid area which says, I have partially applied, can I take 4 points? The answer is no. You're either fully compliant or you're non-compliant. There is no partially compliant situation in any of these questions that come in. And therefore, we should be able to evaluate this closely. These 6 categories here under quality review has client and engagement acceptance checklists. Now, one may ask, what is the difference between client acceptance and engagement acceptance? Again, the manual we spoke about in 1.2 should principally differentiate what is client acceptance and what is engagement acceptance. This differentiation normally comes from how will the firm decide whether they want to work with this client? What is the work? That's another matter. That's engagement acceptance. But do they want to work with this client itself? So that evaluation has to come in. Second evaluation comes on engagement. Do I have the capability and competency to deliver on the engagement? Should be the basis of accepting that engagement. This portion is also linked with 1.4 when you go to the next slide. Next one is an evaluation of independence of partner and all staff on engagement. Now, keeping in mind that these are factors that should not be demonstrated only by mind, but also by documentation, because these are subject to audit. Firms should set up a mechanism by which they are tracking how their staff are concerned as far as the audit is there. Are they independent or not? What considerations are factored? Are staff aware of the various factors one needs to consider from independence? Is it only from a financial risk to make sure that do not have investments, which ensures independence? Do we have to see whether they have any other financial relationship with the company? For example, if you're auditing a bank and all your staff members have huge housing loans taken from that bank, are those staffs independent? Can you do the audit of that bank if you have people who have taken loans from that bank? So these factors need to be built in. There should be limits specified, or will that be permitted? Will it not be permitted? How does the firm ensure independence? So there is a policy and its implementation falls under this. What is the policy for withdrawal or rejection? That is, at what point in time and under what circumstances will a firm choose to resign as auditors? When will they not offer themselves for reappointment after a period of 5 years? There should be clear-cut instances that under which the firm will do this. There should be standard checklists ensuring compliance with accounting and auditing standards. Standard formats for business understanding, materiality and sampling, data analysis, and controls evaluation. All the above should get covered as far as SQC is concerned, and how does the firm ensure they're compliant with the requirements of SQC1. Key aspects here again, this is not just about how the firms practice, but also whether A, there are detailed policies and procedures, sufficient training that happens for all staff. How does the firm ensure or monitor that whatever is the policy and procedure, whatever is the training provided, is in fact getting implemented at every engagement. As I said, there are interlinks, so you may want to read this also with 1.2 as far as standard formats go, because you cannot say there are standard formats there, but then say there is no standard format here. So they both have to be yes or both will be no. So you got to understand, because of this interlinking, you may first look at it and say, oh, I should easily be able to get more than 50%. But when you start seeing the interlinking and realize that a no in one place can result in no in other locations, you may suddenly find you're not really 50 to 75% complete. You may be less than 50% and therefore need to revise a lot of things that you do. Next item is on service delivery. Now, this requires capacity planning for each engagement. That is, do you have the necessary staff with the necessary skill sets to do an audit? And this gives you 4 points or 0 points depending on yes or no. But carefully, this has to be evaluated because this is linked to the earlier 1.3 where we spoke about client and engagement acceptance. You can't say there is no capacity planning and give yourself a 0 and say yes as far as engagement acceptance goes. So both will become no or both will be yes. Maintenance of a process of budgeting and planning for the efforts required to complete that engagement. That is maintaining time budgets. This again is supposed to be maintained engagement wise. So it's not overall that I have got 300 clients I'm serving. I have 400 engagements consist of financial statement and tax audit. I will be doing it through the year. I roughly need 25,000 hours. I have so many people and therefore I'm able to do. That's not what this is talking about. The process of budgeting and planning is both at two levels. One is at the firm level and one is at the engagement level. So both need to be done. And analysis of budget versus actual efforts. Evaluation of what is the arising costing that is coming in and how far are you from your cost and the fee. So this also is key. Now, when you talk about costing, a firm should establish a clear-cut method of costing. It cannot be, this is the salary I pay, and therefore this is my hourly cost. All costs incurred by the firm, which include technology costs, payroll costs, office administration cost, the cost of the laptops provided to staff or other costs that come in, the rentals of the office, all of this should get turned down to billable hours that is available and work out what therefore is the hourly rate. Your hourly rate also will differ from the different levels, and therefore you should allocate it according to those levels and then monitor your overall costing based on time spent and see whether it is close to significantly different from the fee you're recovering. And this requires that you have a process of explaining these differences, what has caused this difference between budget and actual. Now, the way the points go in, have you done this for at least 10% of your engagements? You could get 4. If you've done it for less than 10%, you'll get 0 points. If you've done it for more than 90% of your engagements, that is when you get the maximum points of 20. So there are grading buckets that are applicable here. Suggestion, therefore, would be try and get this done for a significant number of your engagements, if not all, at least to get a higher score. Next one requires a deployment of technology. That is, are timesheets being captured on worksheets, or is it being captured on the net? Is it a tool that is available for everybody? Is it dashboards that come in for review and examination for the leadership as to what is happening as far as time and effort is concerned? Are they close to meeting budgets? Are there still a lot of gap available? Do we require to revise the budget? Should we go back and talk to those charged with governance for a change in fee? In order to be able to take all this decision, there should be readily available, accurate data that is there for the leadership. Therefore, there's an evaluation whether there's sufficient technology being used. Again, it's also yes and no. So you can't have partial technology, partial manually being done and say yes here. It could fall into a no, depending on how much is automated and how much is not. So when you're looking at this technology, keep in mind this 8 points is also linked to serial 1.8, where you talked about technology deployments. So you can't say yes here when you're saying no as far as technology deployment goes. Then we get into quality control. 1.3 also spoke on quality, but that was on quality manuals being there. This is more ensuring compliance, which means, do you have a process of quality review? Now, this is not peer review. This is not the quality review, what is carried out by the QRB. This is an internal review that is carried out by the firm on a regular interval for all its engagements or all its partners to ensure that they are meeting the necessary quality requirements. That is, you have your policies, you have your procedures, you have your standard formats. Are they all actually being implemented or no? So there was a need for implementation in 1.3 as well. And therefore, that gets correlated with this process of implementation that is there under SQC. So these 8 points, you can get only have a process for review. And only if you're able to get these 8 points, can you get the score there, because that also requires demonstration of implementation. Engagements being concluded as satisfactory as per quality review. Now, here it is a case of, both internal or external. That is, if the QRB has done a review of certain engagements, how many of the engagements that they're done have with nil findings over a total engagements review? So if they've looked at 2 files as far as the review goes, 1 file had findings, other one did not. So you look at it, it's 1 without findings over a total of 2. So you fall into 50% bracket. And therefore, that's how the points will come in. So it depends on how many files are reviewed. Another one is this internal. When we spoke about compliance with para 60 on quality review, these are internal reviews to ensure that engagements are in compliance. Again, how many files did the firm get reviewed? How many files were compliant? How many files were non-compliant? And again, depending on these percentages that you fall under, you get points. Now, documentation is required under the SQC1 on ethics, acceptance, and performance. When you say ethics, acceptance, and performance, again, I go back to the earlier slide when we spoke on 1.4, you're looking at acceptance of client and acceptance of engagement. Now, what are the criteria of acceptance will fall under the documentation here as to under what circumstances can you accept a client, what circumstances can you accept an engagement. 2, how does the firm ensure compliance with the code of ethics and additional ethics requirements that are there, and overall performance of audit quality. When you start looking at all of this, one question does come in mind. Should the firm then have a quality leader, an ethics leader, and somebody who monitors everything as a performance leader? So there could be additional positions that actually come within a firm in ensuring all these compliances, which is addressed in the next point as far as SQC is concerned. When you talk about leadership roles on quality, human resource, and monitoring being there. Now, one person may not be able to do all three. Therefore, you may end up with 3 new leadership positions to ensure compliance with AQM. Another aspect of scoring comes in, and this again goes back with standard documentation. So again, both have to be yes or both will be no. You can't have one yes, one no here. You have sufficient accounting and audit resources that make available to everybody. Q&As, that is like an FAQ. What are the standard questions teams can ask and provide them with the answers for reference purposes. Thought leaderships that are getting provided. And all of this should be on an in-house accessible desk, technology desk. Again, this impacts your availability of standard formats, impacts on deployment of technology. So both these get impacted by these yeses and nos here. Time spent on business understanding, planning, and risk assessment. Now, there is one word that I learned early and something that, as true and fair, we keep talking about. Planning has supposed to constitute about 60% of your time. 15-20% will be on concluding or execution that happens. Balance 15-20 will be the concluding and reporting requirements that come in. Now, getting into these criteria, we realize planning does not take criteria or importance, but one should spend a lot of time. And there is a requirement here that there is sufficient time being spent to understand the entity and its business, carrying out necessary audit planning and risk assessment, and putting in place mitigation plans for those risks. So you get up to 12 points here or 0, depending whether this is done or not done. So what should we be cognizant of? I think I've spoken on all of this. All of these items are linked with other portions within the requirement of practice management. Now, maintenance of policy, monitoring is covered under 1.5, policy is covered under 1.3. Evaluation of adequacy of resources, as I said, that is linked with engagement acceptance. So there is an impact in 1.4 as we evaluate in 1.5. Also, the time spent on quality review on specific aspects of audit. This is again linked with 1.2, 0.3, and 0.4 as far as evidences of monitoring and maintenance of quality comes in. So these are all interlinked, and one should therefore look at these links as they respond as well. 1.6 talks about benchmarking. Now, uniqueness about this section, there's also negative scoring. Though, yes, there's a lot of discussion that would happen to see whether this should actually be negative scoring or should we limit to 0 and positive only. But here, I think the institute has felt no, negative scoring is important because this non-compliance should have an impact. It can't be 0 points. It has to reduce the points earned otherwise by the firm. Now, first aspect is on following and implementing standard delivery methodology. What do you mean by standard delivery methodology? Which means whether it is performed by X team or Y team, whether it's performed by the Bombay office or Bangalore office or Chennai office of the firm, the experience should be the same. The way the audit is done should be the same. The output that comes off as far as audit quality is concerned should be consistent across all the locations, all the teams, all the locations. This again, when you say yes or no, whether there's a standard delivery methodology, will also go and impact whether there's standard policies, standard documentation, standard templates and formats. All of that will ensure standard delivery. So again, there is a linking. Now, where do I go ahead and get negative scores? There are 3 aspects here where you can get negative scores. But fortunately, the instances of these actually happening should be minimal. 1, how many of statutory audit engagements were actually reworked? Which means A, the financial statements had to be withdrawn or audit report had to be cancelled out. Additional procedures had to be done. The financial statements had to be restated. New report had to be provided. Now, instances of restatements hopefully should be low. Therefore, chances of this coming in will be a little minimal. Next aspect of negative scoring, and these scorings are, if you don't have any rework, score is 0. If you have any audit engagements which are getting reworked, score could become -4%. -4 score number. Number of client disputes, and this is other than fee. So auditors feel a provision is required on a receivable balance. Management feels there is no, that is a dispute. Whether it results in a qualification or no, this is evidence of dispute happening. And if does not result in a qualification or appropriate resolution, one should see whether disputes resulted in less than 5% resolution, 0 points, 5% to 15%, then you get minus, depending on how the disputes, if it's unresolved, you get -1. If more than 50% of disputes remain unresolved, then you'll get a -4. Timing of audit interactions with management, which means this is again linked to 1.4 when we're talking about adequacy of staff and timing management, and it'll also get linked when you go forward to 1.9 on time management. When and how will the firm actually interact with management to ensure that all the information necessary for the auditor to do what is required to be done within the timelines are provided? So a requirement list with a clear dates and when management has to actually share that information should be provided. And therefore, whether you do it or not do it will give you 0 or 12 points. Another aspect is client sensitization. Now, what does it mean? Now, we did speak about a lot of gaps that come in as far as expectation is concerned. And one of the elements to ensure that this expectation gap is reduced is having awareness meetings with clients. What should these meetings involve? It should involve 2 sets of meetings, one with management, second with those charged with governance. This should include discussing key audit issues that have come up. What is the resolutions that's identified? In some cases, we agree on certain periodicities, saying that we will ensure an improvement because nothing can be done overnight. And therefore, management also would need time to put things in place. Reasonability of the period by when it should be put in place are discussions we will discuss as part of audit issues. This communication can go in writing, can be oral. If it's oral, ensure you have sufficient documentation in file that this communication actually took place. Having discussion on recent updates. There are changes in laws. SEBI keeps coming out with new regulations. There are revisions that are happening within the Companies Act. There are changes that are happening in accounting standards as far as disclosure goes. So it might make sense to the audit firm to actually have a discussion with management and those charged with governance on recent changes and how these recent changes actually impact the company or the way that the firm intends to do the audit. Another aspect is follow-up on what were the observations of last year as far as the audit was concerned and evaluating how the management intends to ensure that the same problems do not arise in the current year. So some of this could work as awareness meetings with clients. The monitoring of planned versus actual hours. Again, this goes in line with what was there previously on 1.4 when we spoke about budgeted versus actual hours matching. So this is planned versus actual hours. And there should be a monitoring process, which means reasons for variabilities or variances are documented. For example, I can give you is I factored I'll use an experienced person and therefore budgeted work of about 40 hours. Finally, the experienced person that I budgeted was not available and therefore I had to use somebody who's new. New person may not be able to do the same thing as an experienced person and therefore that person took 60 to 70 hours to finish. Now that differential additional 30 hours will be identified and allocated saying because I used a junior member of the team to do it, I took extra hours. So you may not therefore bill this extra hours to the client because the client is not at fault for you not putting an experienced person on the job. So these evaluations and documentation should remain in each engagement file. 1.8 speaks about technology. Now, there are 13 criteria, which each criteria either having 4 points or 0 points, depending on yes or no. First one is whether the firm has an internal chat communication, which means whether you're using Yammer or Skype, Teams, whatever maybe that we're using for internal chat communication. As a requirement, there should be a clear-cut IT policy, which says what will be used. Ensure all systems have that installed on them. Then people properly use them and do not use external software such as WhatsApp or other tools to actually chat, but use the formal internal firm tool. An automated attendance and leave system, whether you have it or don't have it. Project timesheet management, digital storage of records, centralized server or cloud maintained server. A digital library. Again, this goes back, I think, to 1.3 when we spoke on quality, that all the standard formats and references, FAQs, guidances, thought papers are maintained centrally. So that forms a digital library, and therefore these two get linked again. Especially after COVID, a need was considered of also being able to do things offline. So use of video conferencing, how are these being used as far as team interactions are concerned, ensuring that the licensed software being used on your laptops are actually licensed and not unlicensed softwares, having your own domain and email use, which means confidential client information is not circulating around Gmail IDs of individuals, but you have a domain and email that is used. Ensuring all systems have antivirus malware protection tools, ensuring there's a policy and implementation of data security policies as well as cyber security policies. Now, all of these will just say yes or no. Again, just having policies for all of this is not sufficient. Implementation or adoption of this also needs to be shown. And that is the next point, that we are able to demonstrate adoption of technology and all these aspects. Key thing coming in, how does all this technology actually move into audit delivery? So this could be an audit tools or analytical tools that are getting used. Depending on what you're using, you can get into yes or no and 0 to 12 points. When you start looking at this, also key would be that all firms may need to have their own IT teams or outsource it to a specialist outside to maintain their data centers, maintaining their servers, ensuring all systems have the necessary security restrictions, whether it is antivirus software, data security, whatever. So you may need to have an in-house IT team. On using of audit tools, yes, there are a lot of tools in the market. True and Fair ourselves are looking at coming out with a tool shortly on how to be able to maintain all audit documentation within a technology tool. Analytics and use of analytical tools. Excel has its own share of analytics it can give. So use of Excel or even Power BI for those of you who are using Microsoft. Both good visualization tools from using analytics, and you may be able to meet your requirements by using these tools. 1.9 covers revenue, budgeting, pricing. Again, when you look at budgeting and pricing, these are kind of linked with what was there earlier when we spoke about management of time, budgeting of time on an engagement, analysis of costing, comparing costing with actuals and budgets, and comparing that with the fees, which we covered under 1.3, 1.4, 1.5. Those also come into 1.9. Now, key things here, client-wise revenue and ensuring compliance with code of ethics. Currently, it talks about no single client being more than 40% of revenues. But once there are revisions in part A of the code of ethics, this 40% is going to come down to 15%. So no individual client, and client refers to the entity, not statutory audit. So your audit fees, your tax service fees, or any other fees that you're getting, certification, none of that in aggregate can exceed 15% of your total revenues. Fee and scope should not infringe upon quality, which means if your cost based on the time that you allotted, the cost rate that you're applying for per hour, evaluation of the overall time cost, you make adjustments saying, I budgeted for experience, but I got a new guy, so he took extra time. Extra time is not billable, and therefore I excluded. Do whatever adjustments you need. But once you arrive at what was the actual cost of an engagement, one of the requirements also would be to map that to your fee and see, have I been sufficiently compensated or not? And only if you're sufficiently compensated, you may be able to take that forward. Another thing that comes in is, each firm is supposed to look at its overall costing and evaluate and confirm what would be a reasonable fee and establish a minimum fee, which means no engagements can be accepted by the firm for a fee less than that minimum fee. And once this minimum scale of fees is established, ensuring consistency comes in. Has it been done, not done? If it's been done up to 50% of engagements, you get about 2 points. If it's done for more than 50% of engagements, you get about 4 points. It's compliance with minimum scale of fees, or a firm does not have any minimum scale of fees, you get 0 points. So all of these come in as far as managing your revenue and budgeting. This is as far as practice management goes. All those 9 points give you about 280. And depending on whether you want to get into L3 or L4, You'll have to look at all of them and see what all are you actually complying with. Look at the interlinkages that they have and see, are you able to get the score that you need? And then plan on what changes in your practice you need to do. The second one that comes in, and then we move back into the performance management, is human resource. There's a huge amount of score that is allocated to this. You get about 240, and this is split into 5 subsections, covering resource planning, employee training, turnover and compensation, qualification skill, and performance evaluations. When I look at all this, and when we went through all the subsections that was there, one key thing that did come into light is I think all firms will actually have to establish a very strong HR department. Somebody who actually looks at what is being done, how recruitments are being done, discusses with staff to know, how their feedback is on compensation, experience, and also ensuring performance evaluations are carried out on a timely basis. So you may actually have to set up a core HR subdivision within the firm. Now, what does this cover? One is on resource planning and monitoring. Again, when you start looking at these aspects, you'll find some of these are linked to what we spoke on the section 1 on performance management, where we were looking at budget being maintained for time being spent, actual time being compared. And therefore, one of these aspects of resource planning and monitoring covers how does one actually capture the actual time. So need for resource planning per engagement. Do I have the right people for the right job? This evaluation also has an impact on 2 aspects of 1.3 on when you're doing engagement acceptance, and 1.5 from a quality perspective. Do I have the right team for the right job? So that's also linked here. So if you see the linking, it's not just interlinking between one section. Between the 3 sections also you'll find the interlinking happening. And therefore, a no in one place can result in zeros in all the related categories as well. Tools used for resource allocation, whether you use an Excel sheet, do you have a workflow or project management tool? How does one monitor for this engagement, this client? These are the people allocated, and therefore these are the only ones who should work on it. A lot of cases, depending on size of the firm, this is done, just on a book or a Excel sheet or a piece of paper, however things go. But need that has come in now is this should be all linked to an element of technology, and therefore firms may need to see what would be the best way to actually capture who are the resources, who are the clients, and which resources are being mapped to which client. Another one is tracking employee activities and productivity. This basically means having timesheets. How often are employees submitting timesheets? Are these manual timesheets, technology-related timesheets? Again, indicating towards technology-related timesheets. Minimum ratio that is being there, which means a ratio between how many partners to managers, how many managers to staff. And therefore, when this ratio itself comes in, it clears a clear indication. Any way a firm is structured, there has to be at minimum 3 levels. There is a level where staff is there, and the staff can be article assistants as well as qualified chartered accountants. Then there's an experience level of manager, and then the partner. So minimum 3 levels should exist in all firms. There should be a method of monitoring. How are you ensuring utilization and realization? So what do you mean by utilization? What do you mean by realization? When you get into utilization, there are 2 elements of utilization. One is working out the total billable hours available. Now, when I say billable hours, we're talking about, say, roughly 40-hour weeks. You have about 52 weeks in a year. So you end up at about 2,080 hours. This is the overall available billable hours of an employee. But then I need to factor, I give them 23 days leave. There are various about 10, 12 holidays that they're eligible for. There is time required, and we get into some of the slides, for all of them to attend training because they need to be updated. So when I start reducing this time, it may turn out that I do not have 2,080 hours. Actually, I actually have anything between 1,600 to 1,800 hours. Now, that being the total available time, you are supposed to track what is the actual time spent on engagement or client delivery. Take that as the numerator, this total time available as a denominator, and the ratio that you work out is the utilization. So one is supposed to monitor utilization, evaluate where employees' utilization is underutilized, where somebody is spending more hours than they're supposed to and getting therefore more than 100% utilization. Because there are subsequent subsections which also talk about, are you providing sufficient leave and time to relax to your employees or no. Now, to ensure sufficient there, you have to monitor utilization here, which means indirectly there's a linking between the two. You can't say I'm not monitoring utilization, but then say I provide sufficient leave to my staff. Documenting a resource plan per engagement, which means at engagement level, there should be a clear-cut plan documented in each file as to who's going to be doing what area and how much time will be required to complete it. Which means it's not just an overall budget where you keep reallocating it. You get down to the field and say, okay, this looks complicated. Let the manager look at it. This is simple. Let the staff look at it. No, there should be a clear-cut plan well before you actually get on the field. And this plan should be included in the file. Key things to keep in mind to actually be able to achieve all of this. That means the firm should have a robust MIS reporting system and a process of taking reports out or having dashboards and analyzing the outputs. Another one is having a structured pyramid. That is, there should be a ratio of manager to partner, which means one partner can have, say, 5 managers, each manager will have 5 employees, and therefore that will be the pyramid that will get set up for the partner. What is an acceptable pyramid? How should it be done? Is also something that needs to be set up by each firm. There is no strict model, but the firm should set up what is sufficient. Monitoring skill sets, experience, CPE credits being earned. So how do you ensure all of them are up to the skill? Because you can only allocate those people who have the necessary skills and experience. And this can be achieved only by doing necessary work, by garnering CPE credits, by building up your skill sets, doing additional certifications. And therefore, the HR department should actually track and monitor all of this. The next aspect that comes in is resource turnover and compensation, which means what is the ratio in which people are leaving the firm. Are significant number of people at different levels leaving, in which case your turnover ratio is very high. There are some problems or an evaluation and rectification and remediation is required there. Similarly, compensation. Is the compensation being paid to your staff appropriate? Is it in line with how the market is going on? Are you underpaying, overpaying? All of that evaluations also need to be carried out. So there are about 6 categories here that we'll discuss quickly. These categories cover on team composition, how many managers, assistant managers, paid assistants are on engagement, what should be the composition that I will use to ensure my overall costing is in line. How do I maintain and monitor turnover, and what measures do we put in place to minimize the same? Retaining sufficient qualified professionals per partner, which means your team cannot be partner supported by article assistants. They have to be qualified chartered accountants who take the position of managers between the partner and between the articled assistants. And therefore, based on how many are there per partner, there are points that is given up, where the maximum points can go up to 20 if per partner there are 10 or more chartered accountants who are working under that partner. So minimum less than 3, you get 4, and 10 and above, you get 20. So ensuring you're able to maintain this ratio to get the number of points that you need to meet the 70% or 50%, 75 or 50% criteria, you'll accordingly have to recruit and maintain that many staff. Service period of the professional with the firm. When you're looking at people leaving, we also have to evaluate saying, are the people leaving within or less than a year with the firm? That means there's something wrong in the way you treat new employees? Or are the people leaving are those who finish 10 years, 15 years, 20 years with the firm? In which case, have you identified what is causing people to leave and putting in remediations to address that no more people leave? Ensuring statutory contributions are being made and appropriately for all staff. This is more like a statutory compliance. Again, are all insurance payments being made, gratuity payments being made, PF payments being made for all employees on appropriate basis and a timely basis. Now, evaluated between different engagements, which one has higher turnover? Which means once you start identifying that there is a number of people leaving, a requirement also is, are the people who are leaving linked to a specific manager, linked to a specific client, linked to a specific partner? And then evaluate whether the cause for this increased turnover is perhaps the client, the engagement, the partner, or the manager, and look at making necessary changes and training for those people to ensure that the attrition levels come down. You also have to look and ensure that there's a framework that is established on how do you promote somebody So what are the KPIs you have put in? How do you evaluate compliance and meeting of those KPIs? At what point and at what level and how many years would you promote somebody? And this promotion, what will it result as far as compensation is concerned? So there should be a clear HR framework that is put in place. Again, there is a use of technology and infrastructure. How does one ensure that all these are put in place to ensure improved day-to-day work and facilitate remote working? Especially this has come up post-COVID, and most of the firms should be able to comply with these requirements. But keep in mind, if you're doing listed entities, there's a lot of confidential data that is being moved. There is an element of UPSI that does come in. And therefore, even though you're using technology, how do you ensure that there is a better process of working, especially remote, keeping in mind all the security requirements? There should be a coaching and mentoring program, especially for women employees, to ensure, because there is a standard trend that comes in that, when you start out as articles, when you work on as managers, women employees are usually significantly high. But when you start looking at the experience levels, you find that the numbers or percentage in numbers starts dwindling, and therefore there should be necessary coaching and mentoring programs. Additionally, a firm may also need to look at how do I enhance the way of work that is there to bring in and be able to retain more women employees, because there is a lot of focus on D&I, that is diversity and inclusion, and ensuring such diversity is available within the profession is also key. And this scoring comes based on how the firm has ensured this. As I discussed earlier, there should be policies to provide staff time to rejuvenate, especially during busy audit seasons. Now, only time you will know whether a staff needs rejuvenation is if you have monitoring of time, looking at utilization. If you see somebody's utilization is constantly between 90 to 110%, clearly that individual needs time, some vacation, some leave to rejuvenate. So this monitoring should happen, and there should be a policy of how much time you give, when do you give, how do you monitor this, and there again you get scorings. There should be policies to support well-being, which means how do I ensure not only physical health, but mental health of the employee as well? How is this communicated to all staff? How do I ensure they're all aware of the support that is being made available and are able to use it? Both of these go hand in hand. You can't say I have a policy, but no staff knows about it. So both need to be met for you to be getting a score on this category. You should also have a mechanism set up for listening to people, taking their views, getting their suggestions. You may have a box put in place for them to anonymously put in suggestions or recommendations, or a process of having a skip level discussion where the partner meets with all the audit staff, a small group of audit staff on a regular basis, take their inputs on what needs to be improved and evaluate what needs to get done. And so therefore, they should be similar to how you may look at an audit committee presentation where you have observations made and you have an action taken report presented in the next meeting. Similarly, here as well, once you take the views and opinions of the people, there should be a process of updating them on what revisions have been done, how their comments, their requests, their concerns have therefore been addressed. There should be a standard for recruiting people, which means having sufficient job description. How do you assess whether these people meet the requirements that are there, and what should be the assessment? Now, when you say assessment, there are various categories one looks at. Does the person have the necessary skill sets, the necessary experience, so certain levels of maturity, good communication, availability of time? All these factors may need to be looked at and evaluate, saying, is this the right person for me? Therefore, there should be sufficient policies and standards on how does one do this evaluation, and how do you ensure that the person being recruited is the right person for the job. So again, whether you have these standards, processes, policies, documentation will ensure whether you get a score or not. The last one comes in is on, are employees being compensated as per a defined approach, where the salary is mapped not just to the level that is there, but knowledge and experience level of the employee as well, which means I could have a case where not all managers are drawing the same salary. The experience and knowledge that each of the managers have, if there are different, the level of salary could vary. And therefore, whether you have a policy of ensuring that everybody is compensated correctly to what they deserve, that is being maintained and monitored. One may need to also look at, when you start looking at all these factors that come into, and there's a more than 100 scoring that is associated to this level as well, is under the ESG principles, which is on environment, social, and governance. Under the social category, there are a lot of aspects of how a company ensures the well-being of its employees. Now, most of these questions come in from there, and therefore you could also be stating you are in compliance with the social requirements as far as they apply to the firm or their internal staff are actually getting maintained. Qualification skill sets of employees. Now, the uniqueness here is, the requirement. And if you look at the questions, they'll also indicate to you, you're required to look at whether you have professionally qualified members within the firm and do they have the necessary skill sets. And this is also looking at as far as number of professionals, partners are concerned, how many chartered accountants do we have? And you may include all services when you look at this, which normally could be statutory audit and tax audit service lines, because you're looking at audit and assurance as a team. And therefore, you will not include, if you have a separate tax service line, you have a separate valuation line, even though they may have chartered accountants, this would not fall into that because it's very specific to the audit services being provided. Now, the percentage of chartered accountants to the total number of staff, less than 30, you get 4, more than 50, you get 12. Now, when you look at total staff, you are including all your article assistants here, and therefore ensuring a good pyramid is important for you to be able to get good scoring here. Do all the professionals have the necessary post qualifications and are they being tracked? We discussed earlier when we spoke on competency, there could be a need for valuation specialists, there could be a need for IT specialists. And therefore, if any of the chartered accountants on rolls have done additional certifications on valuations or have done the CISA, DISA, IP certifications that the institute has, monitoring that, yes, they have qualifications over and above being a CA. What are those qualifications? How does that help? How is the firm utilizing these qualities or experiences that these people have to better improve the services they provide? Now, all of this also needs to be tracked and seen whether the company is doing, the firm is doing this or not. Now, this section is not applicable to a firm which is not involved in doing any IT system audits, which means reliance on IT systems is not being taken as part of an audit there, or the audits being done are so small and irrelevant for an IT system audit being required. Members with specialization courses, looking at, let's say, institute did have an IFRS accreditation course or an INDAS accreditation course, whether you have it. There are a lot of tools and e-learnings in the digital hub that the institute has, where we're looking at analytics, being able to audit in a digital world. Now, these require additional skill sets to be done. And therefore, if members are completing these courses, the HR has to monitor and track how many and what are these specializations being done. Now, if there are less than 30% staff who have done any specialization work, then you get 4 points. If there are more than 50% staff who are doing specialization work, then you will get 12 points. So again, you may need to look at what kind of people you recruit in order to get the maximum number of points that you can under this category. Now, when I'm looking at performance evaluations, this is the last portion that is there within human resource management. Developing KPIs and how do you monitor performance as far as meeting those KPI requirements, both at a firm level as well as partner or individual levels. These need to be written out and documented clearly. Now, when I say documented clearly, it has to meet what, as far as HR, people talk about a SMART technique. So it is very distinctively identifiable, clearly documented. It is measurable. You cannot give vague KPIs where one person cannot measure, have I met 50%, have I met 100%, not possible to evaluate, then the KPI is not clearly documented. So one needs to ensure that a putting so that it's very clearly understood. There is no ambiguity in what needs to be done. Those are measurable. So one can say whether I met 10%, 20%, 50 or 100% of the KPI, what has been done. And these should get linked to the roles and responsibilities of a partner. So when I say roles and responsibilities, there are different roles a partner could play. One is as an engagement partner. There are certain KPIs, that is maintaining sufficient audit quality on the engagement. The partner could also be taking the role of a CEO or managing partner. So they'll have certain KPIs there. As we've discussed, the way things are going, you may also have to have a partner who leads quality. So you'll have a quality partner. what are their roles and responsibilities, and how are their KPIs put. So all of this could be different depending on what the roles are, but they should be clearly documented. And the compensation, and when I say compensation, there are two elements that you pay a partner. You pay a partner compensation as remuneration and profit sharing. So what percentage of profit share comes in, how much will be paid as remuneration, all of this should be based. It cannot just be a policy that I will pay so much. They should be based on evaluation of meeting these KPIs, as well as ensuring internal quality reviews. I think we spoke it in 1.5 when there should be quality monitoring that happens, where a company has a process of carrying quality review of various engagements. If a partner is meeting the quality requirements, he gets full points. Partner is not meeting quality requirements, they get either 0 or negative points, depending on the extent of or nature of deviation. So this will decide what should be the profit share for the partner. So that correlation should be documented as a policy. That is as far as HR goes. Then there is a small portion where 80 marks are allocated. This is called as practice management, more from a strategy and function. And as we discuss this, one of the key points that also comes up is if one needs to comply with the practice management that we spoke earlier, the human resource requirements, a firm which is of mid-size, it will become very difficult to manage all of this, monitor all of this, as well as manage the costs associated with this. So when you get into practice management, we'll also see that some of these points are actually indicating, and that goes back to the initial idea around Aqmm, where the institute said this is a capacity building model. Some of these things will start focusing on, do I need to start and getting into a network? Do I need to set up a network formation so as to get the necessary requirements under this category as well? So there are three aspects one is looking at. One is practice management, having physical and other infrastructure requirements, and practice credentials. These are the three categories under which the scoring happens for strategy and function. So when I look at practice management, we are talking about, a balanced mix of new and experienced partners. Scoring goes saying, and again, there is a levels of experience which goes on less than 5 years, 5 to 10 years, more than 10 years. And you're talking about experience. This is not experience with specific industries. This is post-qualification experience. That is, as a chartered accountant, how many years of, but here you have to look at relevant experience. So this is not just how many years of post-qualification. You may want to look at how many years of audit experience post-qualification when you actually put this scoring. Compliance on professional independence and conflict of interest. Now, there are two aspects here. One is, do you have a process as a firm? How do you have or evaluate compliance with independence policies? Do you have a tool by which you're able to capture this information and identify possible conflict of interest? What does this mean? I have a team which is conducting an audit of a company. Now, how does the firm and the partner know that nobody in the team has any shares that they own with this entity? Or if it's a banking company, no employee has any loans that they've taken from this company which they're auditing. For these aspects, the best way to be is having a tool wherein a lot of data is captured, where the staff put in information regarding companies from which they've taken loans, instances of shareholdings that they have, which mutual funds they hold in. All of this may need to be information submitted to a central team. And therefore, again, going from an HR perspective, you may need somebody who manages independence and conflicts. And therefore, there's a separate partner identified for managing this as well. Another one is existence of whistleblower policy. Now, as auditors of listed companies, I'm sure we've already seen compliance with SEBI requirements, where SEBI has also mandated an existence of whistleblower policy. We're reporting in CARO whether there are output of whistleblower policy has been addressed or no. So in those aspects, we expect a company to have a policy. What has come in here is that even the CF firm should have a whistleblower policy. Now, when you set up a whistleblower policy, who will get the complaints? Should it be the managing partner? In which case, can somebody do a whistleblower on the managing partner at all? Because that would go and that will get squashed there itself. Which means there may be now a need of an independent chief risk officer coming in, who will actually monitor and see what are the whistleblowers that are happening. So as you start looking through all these aspects, you will already find that we've looked at more than one additional role coming in. You have a chief risk officer, you have a chief people officer, you have the chief quality officer, chief independence and compliance officer. So you have 5 different designations coming out just from ensuring compliance with Aqmm. So firms will have to start saying, if I start designating these levels and I have KPIs for each of these levels being different, because they should be based on the roles and responsibilities. A firm which has only 2 partners, 3 partners, if they are auditing and listed company and are required to comply with Aqmm, will have it difficult, because there a partner is not only handling client service, he also has to do, or she has to do, all these other additional activities. So again, this is indicating, saying if you have to do all this, you may have to have more partners, which either you grow in size, or you acquire and merge with other firms, or you create a network of firms. Because that's the only way you can start building in the required strength and capacity that is required to be able to meet all this. Infrastructure. We did speak a little bit on this when we were talking about sufficient IT tools for working from home that are required. But in addition, this talks about certain other aspects. Do you have sufficient branches? Do you have offices in more than one city? Are you a part of a network firm that is spread across the country, or has approach at least in various other cities other than where you are where your head office is located? If you are there in less than 3 cities, you get only 2 points. You're then more than 15 cities, you get up to 8 points. So one may need to see, again, this is pushing you towards expanding, merging, creating networks. Then how are the processing being done, whether it's accounting, client invoicing, payroll processing? Are they centralized or decentralized? If they're centralized, you get more marks. If it's decentralized, where each branch has to do it on their own, you get lesser marks. Physical, logical security of information. We did discuss this a little earlier when you're talking about work from home. How do you ensure there are sufficient security features established such that information, and especially UPSI, because Aqmm is mandatory for auditors doing audit of listed entities. And therefore, every team member has access to UPSI that is there. And how does one ensure that there are sufficient security measures that this data does not leak or get shared with unauthorized personnel? So this is both physical and logical security requirements. Adequacy in use of tools and IT infrastructure for relevant assignment. Now, when you're talking about tools, we're talking about tools for both audit as well as analytics. Do you have sufficient tools? And this is again getting linked to 1.9 when we're talking about application of technology. So these two need to be read with each other. Adequate infrastructure for remote working. Again, this goes and maps earlier when we spoke about having sufficient infrastructure for working from home. So that was in HR. Now this is in strategy and function, but both are talking about infrastructure for remote workings. Last one is practice credentials. Here again, there are elements of negative scoring, but this probability of negative scoring is substantially low and may get avoided also if, for example, you're looking at any advisory by CAG office. But if you are not empaneled with CAG and therefore not doing any work with CAG, the chance of this coming in is very low. You'll probably sit at 0 points. But at the same time, if you for 0 points, you do not register with CAG, you lose the chance of being able to get 8 points. If you look at point number 2, if you're empaneled with RBI or CAG, you get 8 points. If you're not empaneled, you get 0 points. Here again is because when you're empaneled, both RBI and CAG have a process of further scrutinizing or reviewing the quality of the firm, and therefore you get more marks if you're empaneled with them. Again, if your firm has got an ICAI peer review, logically, since this applies to listed entity auditors only, and listed entity auditors have to be subject to peer review, there's no option. Therefore, this chance of getting 4 points is very easy. Regulatory authorities have evaluated performance to the extent of debarment of blacklisting. This could come from courts, FIO, NFRA, even the ICAI, if they've taken any position where they've banned or debarred the specific member for a period of, say, 2 years, 3 years, 6 months, 1 month, even a few days. If this activity has taken place, the firm for that period will get negative points. If there's a QRB report that was issued for any of the engagements that were subject to review, and there were negative comments that came into these reports, then again, you get negative markings. Is there any element of professional misconduct due to which the institute took action and the member of the firm was proved to be guilty? Again, you get negative marks. And basically, this is just ensuring compliance over ethics, independence, ensuring quality of the audit, ensuring monitoring is happening. All of this, as long as you're compliant with everything and there are no negative comments, reports that have come across, this negative scoring should not impact. So what is it that we are trying to do? Firstly, when you look at the Aqmm guidelines, it gives you an impression, in order to be able to be an L3 or an L4, where you have to get minimum 50% or more on all the three segments, or more than 75% on all the three segments, it looks overwhelming. Because a lot of times the firms do not have a quality leader, does not have a chief people officer, does not have a risk officer, do not have HR policies, do not really monitor the timesheets. And if all of this become mandatory from 1st April, is the institute asking for too much? But if you look at it, no, it's not really impracticable. It is possible, capable, and can be done. And most of the items in the Aqmm, more or less everything, is not necessarily new that has come in. These are comparable to global quality standards. Where necessary, institute has made the adjustments to Indianize it, and therefore that benefit has also been done. And you therefore cannot say that these are impractical. The institute has actually done a good comparison with global standards and brought this up as a policy. Key thing here is right now there's no guidance being provided, but these are just 3-4 levels that are being provided. This is a self-evaluation scoring that is getting done. But we need to consider that if you are not an L3, chances of being able to go in on as an auditor to even submit a proposal may be difficult. There could also be an extended expectation from those charged with governance that only firms who are an L4 are permitted to audit PIEs. Therefore, there should be a clear-cut plan, the mission and vision statement that we spoke in 1.1, where a firm has a clear focus on how will they ensure that wherever they may be, they're moving towards L4. And if they're already at L4, how will they ensure continued improvements? Because at some point in time, you may suddenly realize you cannot take any listed entities as clients because you do not meet the requirements of L4. Now, right now, the requirements of Aqmm is limited to only those firms which are auditing listed entities, auditing banks and insurance companies, and not applicable to those which only do branch audits of banks. I would expect in a year or two that exclusion of branch auditors will go away. It will apply to them as well. And perhaps in a couple of years, it will apply even to those firms who are doing audit of private companies. If you can report on IFC on private companies, I'm sure you can report on Aqmm as well, even though you do not do any listed entities. So this would come in. Right now, it's applied for PIs because that is where the focus and concern is. And once that becomes a norm, I'm sure it will expand to all audit firms. So therefore, perhaps this is a good time for the firms to start looking at, should they start setting up networks and affiliates wherein they could have one single person overseeing quality across all the firms in the network, one person who's looking at all the HR compliances across the network, one person who monitors whistleblower and other aspects across the network. And therefore, costs get released because if each firm has to appoint and put 3 or 4 people who will probably end up doing this full time, all of them will incur this cost. But if you start forming a network, then this cost is equally shared by all the firms, thereby bringing down the cost, but at the same time ensuring compliance with all the requirements of Aqmm. So one may need to actually start looking at setting up a network anytime soon. Why is this also important? When you start setting up these structured networks and firms start getting in together and you start complying with this Aqmm and realize there are a lot of you are within L3 and perhaps coming together will help facilitate for you to become L4s. Or there are a group of firms who are already L4s and they want to further improve upon it and therefore they want to come together. Already having met certain levels of these Aqmm standards will ensure that these firms are at least at a common platform and therefore facilitate an easier networking. Why is this important? I'm sure all of you recollect in 2017, our Honorable Prime Minister had made a comment that everybody keeps talking about Big Four accounting firms, but why is there no Indian firm who is out there also representing Big Four? Thereby, there are Big 8 firms, 4 of which are Indian firms. Now, conceptually, this is not happening because there are not sufficient networking that is taking place within India. Perhaps as you start meeting these requirements, firms will start coming together and therefore facilitate fulfilling the Honorable Prime Minister's dream of having 4 large firms from India also competing with the other large firms. Now, how do we get there? A lot of these activities are true and fair. As a firm, we do provide. We are looking at coming out with a tool for purposes of audit, which will facilitate meeting both technology as well as necessary documentation protocols. We are looking at coming up with quality policies, an audit manual, looking at setting up standard templates, having audit procedures standardized, and therefore a lot of those aspects getting met. We also intend to provide training for chartered accountant firms to facilitate, and that means certain elements of human resource. We also have a plan to facilitate networking. If a group of firms want to come together and start creating a network, but do not know how to go about doing this, we also provide consulting work there or advising on how to draft a networking agreement. How do you set up policies within the network, ensuring there's a sufficient board that is created who monitor, ensuring equal representation of all the firms within the network. How do you develop as a group? How do you expand as a group? We provide services of this regard as well. So having learned and understood what are the various factors under Aqmm, which start being in compliance in about a week or two from now, if there is any help that you require in any of these matters, you feel free to reach out to any of us. There's a common email ID as well at contact@trueandfair.pro. You can drop any concerns or communications or support that you need. We'll be glad to reach out and provide you support on those actors as well. Or if you can reach out to any of our partners that are there. As far as today's session is concerned, that is all I have. And with this, I would like to actually open it up for anybody who has a question. Anybody who would like to understand or clarify anything, just raise your hand. The host will unmute you, and from there you can ask whatever questions you have. Again, any questions, please raise your hand. There's a feature on Zoom for you to raise your hand. So you can do that and we will unmute you so that you can ask any questions that you may have. Okay, currently the way it goes is, there are certain categories. We've got a question that has come here, which is asking whether audit planning document and work papers, including budget and actual monitoring, should be implemented for small and mid-sized audits, or whether separate formats can be created for such audits, and the same will impact Aqmm rating or not. Now, if you looked at the way it was structured, there was initially policies that was required, and under the policies, there were 2 aspects. One was your audit methodology tool or audit methodology manual that is there, and the quality manual that is there. Now, within the audit practice manual and the quality manual, if you do bring in that for engagement of this size, this is the kind of standardized documentation I will follow. An engagement of a certain size or PI engagements, this is the process or documentation I will follow. And that forms part of your audit methodology manual. Then no, it will not impact your Aqmm rating as far as the firm is complying with that. So you may want to categorize what companies will fall under small, what companies will fall under mid-size. Is it the fee that decides it? Because fee cannot be the basis of allocating clients into mid-size or small. It has to be the size of the company. So you may want to put certain criteria or take reference from Companies Act or the accounting standards as to what falls under small and mid-size. And for companies that fall there, you could categorize it and have separate methodology plans, saying how will you approach it? Because some of these companies may not have control reporting. And therefore, you don't use that. And therefore, may have a smaller documentation format for planning. So that's more dependent on the manual that you create as far as the firm is concerned. And as long as you're compliant with that manual, your Aqmm should be fine. Yes, that's a good question. After listening to this, it seems that to implement all of these requirements, it would be practically not possible for mid-sized firm to actually do this within a year. If you look at it, it is mandatory for firms to start a self-evaluation process. At no point in time has the institute come back and said that all firms in year one should be L4. That's not the criteria. They are saying you do the self-evaluation, figure out where you stand. Are you an L1 firm, L2 firm, L3, or already an L4 firm? Do your self-evaluation, put up a plan. How do I move? If you're coming at L1, what do I need to do to move to L2? If you're at L2, what do I need to do to move to L3? Can I move from L1 to L2 in year one? Can I move to L2 in to L3? It may take me 2 years. Therefore, it's a 3-year plan. So from L1, I will move to L3 over 3 years. If you're at L2, from L2 to L4 over, say, 5-year plan. But you should have a clear-cut plan of how do you intend to move from where you are to get to L4. That is the actual intention the institute has put this in place. Therefore, they called it a self-evaluation. However, yes, it's about a timing as when you are due as a firm for the next peer review, because the peer review happens once in 3 years. So if you got a peer review done as of 22-23 and you have your certificate now, then till 25-26, the next round of peer review is not due. And therefore, what level are you will not become public information till that time. However, if you're due for a peer review next year, and therefore your compliance, which is effective from 1st April 23, will get subject to a peer review, then yes, you do have a risk that that information of which level you are could become public information once the peer review report is out. But again, as long as your mission and vision statement, which also is something the firm can put it up on their website perhaps to say where they want to go, will clearly indicate that yes, you do have a plan to move up from whichever level you are to the next level. When would the ratings of level 1, 2, 3, 4 be given? Actually, there are 2 levels there. When you do a self-evaluation, that level is only within the firm, cannot become public information. But whenever you get subjected to a peer review, or if you're confident that you're in between 2 peer reviews, if you've already met a level 4 and you want to make it publicly available to your clients, then you may ask for the peer reviewer or Aqmm reviewer to come and do a specific review of your Aqmm. And once that is done, that will get informed by the institute. Now, the way the guidance reads and the Aqmm reads, it is said that once the peer review is completed, the ratings that are given from an Aqmm will be made publicly available on the institute's website. As to how will they be made, once it is out, we will know how the institute intends to make it available. I'm assuming it will work similar to how UDIN goes. Somebody goes and puts in the firm's registration number, their Aqmm valuation details may come out on that aspect. So anybody could go and check it on the institute website. But whether how institute will actually do it is, once it starts giving it out is when even we'll know. Next question. Yes. Are there any instances of this Aqmm being done globally? As far as the models being available, it is there globally. There are a lot of categories that do come in. But as far as reporting on compliance of these quality matters, as what the institute has currently suggested, no, that is not reporting that has come out. However, globally, there is, and what I discussed earlier as well as what the NFRA has currently suggested, there is an auditor's transparency reporting requirement that the NFRA is looking at. If you look at the global requirements, all the auditors who submit their transparency reports, something similar to where they stand on quality is being disclosed there. But it's not in the same criteria how the scoring that the institute has currently put in. Can the team of peer review and Aqmm be the same? Principally, the peer reviewer will be doing the Aqmm reviews. However, the institute's guidance, implementation guide does say that there could be a separate Aqmm reviewer identified solely to go and do the Aqmm review. That's the only reason there's a differentiation, because a peer reviewer also goes in to look at individual engagement files, compliance with SQC, and also compliance with Aqmm. So the peer review scope is higher. So when you're saying, I do not want a peer review, my certificate is valid, I only want the evaluation of AQMM done, then the same person may come, but he'll be called an AQMM reviewer because scope is limited only to AQMM. That's the only differentiation. But it could be the same person. Any other questions? I think that's all the questions we had got so far. To become a large firm like the Big Four, they will need assistance in terms of technology. Is there any plan of ICAI? ICAI has been saying that they have been looking at, and they have also tendered an RFP, trying to develop technological tools to actually have electronic documentation of audits being done. There are also a lot of things that the institute is looking at on as far as analytical tools are concerned. But by when will all this come out is still open. Though the institute initially said they'll try and see if it's possible to provide these tools free of cost to the members, but whether they will be free or no is once the tool is actually out, depending on what cost it is, there will be continuing maintenance, because if these tools are maintained on cloud, there would be continued maintenance. Of course, you may not pay the institute for it, but whoever is the cloud service provider, those charges may need to be paid. So yes, institute is looking at it, but a timing of that is still unknown as to when that will come in. But from an AQMM compliance, since it's mandatory from now, firms individually have to start planning on how they will do this. And as I said, firms may need to consider networking such that the cost per firm can come down. Otherwise, the cost that each firm will incur is going to be exorbitant. Other questions? If there is any questions that come to you later that is also not currently coming up, or you do not want to ask in the public forum, I had shared our email IDs earlier. If any of you have made a note of that, feel free to drop an email, ask any questions that you may have, clarifications you may have. We'll be glad to also provide you responses. At least most of that, however, will be my opinions, not necessarily what the institute is looking at, but based on the amount of research that I've done around this, I'll be glad to share my thoughts on whatever queries or concerns you may have. Okay, if there are no other questions, I think I can give back 10 minutes back to everybody and bring this webinar to a close. Thank you all for attending. Hope the information that we've discussed, the points that we brought out were helpful to help you understand on what the compliance requirements under AQMM are and what one needs to start doing. And as I mentioned, any questions, any concerns that you still want clarified, feel free to reach out, do drop an email, and we will try and get back to you as soon as possible on that. Thank you all and have a good weekend.